You know, investing, just like anything, can be really confusing if you're new to it. You have lots of questions, you hear all these terms and all this jargon like index fund and brokerage account and IRA and all the things, right? But the truth is, investing is really not as complicated as some people would want you to think that it is. Some of you out there, you're completely new to investing. Some of you are looking for more advanced strategies, and a lot of you are somewhere in between. But whatever level you're at, I think it's important to get a solid foundation, go over the basics again before we move on to specific strategies. So I thought it would be helpful to make a video on some of the most common questions I hear from people who are new to investing. Some of you will be familiar with some of these questions, but some of you won't. Hopefully by the end of the video, you'll understand a little bit more about how investing works, what it is, and how you can develop a strategy that works for your financial goals. First question. What is investing? This first question sounds really simple, and it is. But before I talk about anything else, I want to explain what investing is in a nutshell. Now, you probably know that investing involves, buying stocks, buying real estate, buying other assets, and that's true, of course, but I want to go a little deeper and take a step back. In general, what it means to invest in something is that you're putting some resource into that thing with the goal of getting even more in return. So if you say that you want to invest your time in learning a language, you're giving up some time that you could have used for something else because you want to develop that skill. That's an investment. Similarly, when it comes to investing money, you're basically putting in cash up front, whether all of your own cash, right, or a combination of your own cash and cash you borrowed from somebody else for some asset that you think is going to provide more value for you than what you paid for it. It could be real estate. Maybe you want to, flip the property for a higher price, or you're just looking to generate rental income. It could be a business. You want to get a share of the profits. That's what a stock is, after all. You are owning a small portion of a company and sharing in its earnings and its growth. It could be anything that you're paying into so that you can get more out of it later so that you can get a return. That is all investing is in a nutshell. Question number 2. Do I need a lot of money to start investing? Now, there are some real concerns about wealth inequality in the United States. In fact, more than half of all stocks are owned by the richest 1% of Americans. So that leads some people to think that investing is only worth getting into if you're in that category. But that really isn't the case. Getting into investing was a lot more complicated when everything went through actual human brokers, right? But in 2020, it's actually pretty easy to start investing, even if you don't have that much extra cash on hand. You can use a brokerage like Webull. Link is in the description below. You can get 2 free stocks when you deposit at least $100, which will immediately give you a positive return on your investment. And even though you may not think it's worthwhile to invest $100 or some relatively low figure like that, the truth is any amount of money you can put into the stock market is going to be a good start. It's hard to predict how the market is going to perform at any particular time, and you might be able to contribute more in some months than in others, but say, you put in just $100 a month for 10 years. That works out to $12,000 you will have put in total. But if your investments gain an average of 7% per year, you're going to end up with more than $20,000 at the end of those 10 years, which means you would have gained almost $8,000 over that time just in terms of investment growth. The point is that even small contributions will add up over time if you're able to make them consistently. Even if it's just $50 or $100 at a time, it's still a step in the right direction. The key is to get started and to keep investing consistently. Question number 3, should I pay off my debt first before I start to invest? Another really common question when it comes to investing is how high your investment should be on your priority list. If you have some debt, if you don't have an emergency fund or much money in savings, you might be wondering how much progress you should make on those other financial goals before moving on to investing. Ultimately, what this comes down to is the respective return on investment you expect to get from different options versus the risk of pursuing that option. For example, if you have credit card debt that's growing at 20% per year, then at least from a dollars and cents perspective, that should be your top priority unless you have some other option that will make up your losses by giving you a return of greater than 20%. Also, keep in mind the risk here. When you pay off debt, you're guaranteed to achieve that return. But with investing, your return is not guaranteed. There's risk involved. And oftentimes investment returns are taxed either now or in the future, unless of course you never sell. You do a 1031 exchange with real estate, stuff like that. But frankly, if you have high interest debt, and I put high interest debt as around 6% or more, I generally say focus on knocking out that debt first, or even better, look at how you can refinance that debt to a lower interest rate. Now, It's impossible to predict how much an investment is going to return in the future. So I would generally say that credit card debt at 20% is far more pressing than most types of investing. Now, with that being said, there might be some notable exceptions to that rule, but ultimately it's going to depend on your specific situation. One example. Some employers either partially or completely match 401k contributions up to a certain limit. So maybe an employer offers a 50% match up to 6% of your salary. If you're earning $50,000 a year, that means if you put $3,000 towards your 401k plan, then your company will contribute an additional $1,500. That's an immediate 50% return on your investment. And obviously a 50% return on investment is a lot more than the 20% you're paying on your credit card debt, at least in the span of a year. Of course, it isn't quite that simple because debt can lead to some other consequences. If getting your employer match means you're going to have to miss a mortgage payment, well, it probably isn't worth it, right? Because there are other risks that come along with getting behind on your mortgage. But if you're in a situation where you can reliably manage that debt, make the minimum payments, things like that, then you will probably get a better return through your employer's 401k match than you would by just simply making extra debt payments against principal. Now, again, I can't speak to your specific situation, but I would say that you should at least wait to invest until you feel like you have your other financial obligations under control, with some limited exceptions. Question number 4, should I wait to invest until the next market crash? If you've been following the economy recently, you probably know that the stock market had a really quick recovery after the initial coronavirus crash, and some people are worried that the economy still isn't that healthy, and we're going to have another market crash in the near future with cases going up, etc., etc. Unemployment is still up. Eviction protections will run out eventually, and there's a pretty common line of thinking that says those problems are going to lead to a bear market somewhere down the line. And if you're thinking about investing, then you might be thinking that you should wait until the market goes down so you can avoid taking any losses during a future crash. Now, I can't tell you what the market is going to do. No one can consistently. So I can't necessarily say when the exact right time to invest is, but I can tell you that timing the market rarely works out. Now, there could very well be a huge market crash in the near future due to COVID-19 or something else. Okay, fine. The problem is knowing when to get in, right? Market drops 10%. Do you get in then? Or wait till it goes to 20%? Oh, but oops, you waited too long. Now the market shot back up and it's almost back to what it was before. So see, it's not as simple as, I'm going to wait until the market crashes and then I'll buy because I'll know the exact right time to buy. It just doesn't work like that practically. Timing the market is probably the single biggest mistake among new investors who think they can invest at just the right time by following the news or something like that. Of course, it might work out for you this time, maybe even the next time. But the reality is that it's extremely difficult to time the market successfully over any significant period of time. And even if you're better than average, you're still going to come out behind compared to what you would have earned simply by ignoring market timing and just making consistent investments, and better yet, just automating your investments and putting any time you would have spent trying to figure out the intricacies of the market into developing a side hustle or even your own business or some other revenue stream like that. Consistently putting money into the market at regular intervals is called dollar cost averaging. The basic idea is that the best way to maximize the value of your money is to spread out your contributions equally over time. So if you're able to contribute, say, $500 a month to your portfolio, you should make that contribution on the same day of the month and try to stay as consistent as possible just to build that habit. Yes, there are going to be bad months where you would have been better off to have waited until the next month, but there are going to be even more good months that make up for those potential losses. The strategy is also a lot simpler than trying to time the market, and it will at least help you get started if you're still waiting for the market to drop. In fact, I would say you shouldn't even look at your portfolio value too often. You don't want to get caught up on whether the market is up or down on any particular day. You really just want to stay focused on the long-term trends and goals that you're investing for. Question number 5, should I try to avoid risk? Now, one of the most common things you'll hear about investing is that it's risky, and that's completely true. But I want to talk a little bit about what risk means in the context of investing, when you should try to avoid risks, and when it makes sense to take on a higher level of risk in order to give yourself a potentially greater reward. Now, when you're investing over a short period of time, say you have a little extra cash and you want to get some returns on it in the next, say, year or two, so relatively short term, then the kind of risk that you need to worry about is different from the risk you would be concerned about if you were investing for the long run, over decades, 20, 30 years or more. These are called time horizons. And the first thing you need to do when you're putting together an investment strategy is figure out what kind of time horizon you have in mind. If you're 45 and you want to retire at 65, your time horizon is going to be at least 20 years. Some of that money will have a time horizon of even longer, since you won't be withdrawing it all at once right when you turn 65. And if that's your situation, then you really should be thinking about how you can put yourself in a position to get the best possible results over 20 years. So I don't want to get too deep into the specific examples here. I've talked more about this in other videos, but the point is that the risk of a market crash or something like that is much greater, right? Or will impact you more if you're planning to pull your money out in the near future. Basically, if stock prices fall tomorrow and you needed that money next week, then you might be in trouble. You might have to sell at a loss. But if you don't need the money until 2040 or the year 2050, then you don't really need to be worried so much about where the market is in 2020 or even 2030. So there's a lot more I could say on this topic, but I want you to at least take away that risk isn't necessarily good or bad. It really depends on what you want to get out of investing. Question number 6, should I pay a professional to invest for me? Now, investing is obviously a complicated topic, and if you don't have much experience, then it's easy to feel like you don't know the best way to invest your money. A lot of people in that situation feel comfortable just paying a professional portfolio manager or financial advisor, and that might work for some people. But in general, I think for most people watching this, your net worth is not in the multi-millions. I would recommend against paying extra money for someone to give you investment advice at that level or to invest your money for you. Ultimately, what this comes down to is whether that fund manager can generate good enough returns to make up for whatever you're charging you. They got to beat the market by at least what they're charging you. However, you can find index funds that just passively track the market and only charge a few hundredths of a percent in fees. On the other hand, a professional manager might charge closer to a 4%, so it might be hard to actually get that return back. This is just me, but personally, I like my odds of coming out ahead just by tracking the market and getting those long-term gains while losing as little as possible to fees. I don't want to tell you that paying a portfolio manager is a completely bad idea in all circumstances. There's definitely some peace of mind that comes with letting a professional handle investment decisions, but at the same time, every investment has risk, and it's extremely hard to beat the market consistently, whether you're an amateur or a professional. Question number 7, and I get this one a lot as a CPA. Will investing make my taxes complicated? Okay, so the last thing I want to bring up is how and when investments are taxed, because people have questions about that. You might have heard about the capital gains tax, and that comes up when you sell after assets have gained value. But you might also need to pay other taxes even in years where you don't sell at all. Pay tax on your cash flow, dividends, interest, those kinds of things, rental income, right, and losses. Those are going to be reported on your tax return, and you'll be taxed on the income whether or not you withdrew money from your account. If we're talking stocks here, your brokerage will send you a nifty little packet after the beginning of the year with your 1099 dividend. That's how much in dividends you received during the year. You'll get a 1099B if you sold stock, right? That shows the proceeds of your stock transactions. That's usually accompanied by a gain and loss statement for your stock transactions. And these are all pretty easy to work with and input in your tax return software. I'll probably be doing some walkthroughs in TurboTax or other tax softwares as we get closer to tax season. So taxes on investments, and really stock investments in particular, aren't really that complicated. Once you learn a little bit about them, you get kind of used to how the forms look. And even if you do your own taxes, you shouldn't have any trouble accounting for your investments and making sure they're accurately reported on your taxes. Now, for income items where you have to come up with the numbers yourself, such as the income or loss on a rental property, right? That may take a little bit longer. You're going to have to do some bookkeeping, might have to educate yourself on how depreciation works. But if we're just talking stocks here, you should be fine just with your tax software. An important point to remember is that the capital gains tax works differently depending on whether you held the asset for at least a year until selling. If you buy a capital asset like a stock and sell it within a year, any gains are going to be taxed at your ordinary income rate, same as your W-2 income. For example, say you buy $1,000 in stocks. They grow to $1,100 in just a few months, and you're happy with those gains, so you're ready to cash out. So you had a gain of $100. that $100, because you held it a year or less, that's going to be added directly to your taxable income, which means you'll be responsible for paying taxes on it based on whatever tax bracket you're in. There's no special rate for you. Now, what's kind of complicated here is that the tax rules changed once you hold on to those assets for more than a year. At that point, you'll be taxed at the long-term capital gains tax rate. And here's the cool thing. If your taxable income, right, and your taxable income does include the capital gains themselves and your other income, but is reduced for your itemized or standard deductions, so keep that in mind. But if your taxable income in 2020 is lower than about $40,000 for single filers, or about $80,000 if you're married and filing jointly, then your long-term capital gains are taxed for federal tax purposes at a 0% rate. No tax on them. You might still owe for your state, sure, but Uncle Sam won't take a piece. And even beyond those thresholds, the long-term rate is just 15% up to an income of almost $500,000 a year. That being said, I would rather you not pay any taxes at all on your appreciated stocks. Why pay taxes at all, right? Just hold on to them if you can. If you think you made a solid investment in a good company, hold it for the long term. Don't sell it and pay Uncle Sam. I'll probably do a dedicated video on capital gains at some point in the future, but I think that's a fine summary for now. All right, everybody, thank you so much for watching this video. I hope this cleared up some questions you may have had about investing, and hopefully you feel a little bit more comfortable with these topics. Thanks again for watching. Make sure to hit the like button if you enjoyed the video, and I'll see you in the next one. Bye-bye.